Here are some investing keys. You truly do not need more than 7 to 8 businesses that are extremely great to be successful in the stock market. And then you really want to have 7 to 8 diversified ETFs with a long-term time horizon for your retirement goals. The combination of the two will give you great success with the compounding effect. Historically, those that invest based on average market returns are the most successful. And this could be in indexes or ETFs. And once again, the key is having long-term time horizons and never stop investing consistently. Diversification is really good to teach you about the markets and different sectors and different industries. This also limits your risk when you're starting off and allows you to narrow down what your edge is. And in order to learn more, you also need to define your risk. How much can you allocate into different companies? How much can you allocate into your ETFs? And creating a budget throughout the year. So you're not taking huge losses and you don't ever have to go in and out the market when you do need money. Never hyperfixate your mind on the ups and downs in the price of the stock. Learn to know the value difference and the price difference of a stock. Once you define this, it'll ease your way on knowing the prices will always go up and down on different reasons, whether it's macro or micro. The market is always neutral. The market doesn't care about the emotions of investors, whether you're institutional or individual. The market does what it has to do simply based on volume, momentum, liquidity, and the factors of how these algorithms react to the news that they're collecting and the data they're analyzing. I mentioned ETFs a lot, so what is an ETF? Well, define their exchange-traded funds, which is just a basket of investments that are on the stock market. So when you're investing in the S&P 500, these are the top 500 companies in the U.S., and when you put your money in, it allocates it to the entire S&P 500. So you're automatically diversifying, which makes it extremely safe, especially when you're thinking long-term. Now, these go up and down too, but historically it shows if you're consistently investing, then on the days when the market goes from down to up, you make the most money. So that's why consistency is key, because those down days don't matter as much as the up days do for your growth. But if you're investing in the down days, guess what? You get in at the right time. ETFs just don't focus on companies. There's ETFs that hold bonds and commodities also, further diversifying your portfolio. From broad market indexes to specific sectors, to different investment strategies, you can find ETFs on any format. There's a whole another world out there based off of them. And someone like myself who is an active investor, I still have ETFs focused on my passive investing, which are focused on my retirement. So just because you're passive or active doesn't mean you can't invest in ETFs or whatnot. Someone like me, like I said, I do both, and it allows me to sleep really well at night knowing that I have consistent investments that won't just evaporate based on my risk that I take on individual businesses. ETFs have really low fees, and another key factor for them is that they're highly liquid. So you can exit them whenever you want to and whenever you need money. Here are 3 investing experts and leaders that you must get to know. First, we have Josh Brown. Second, we have is Mark Andreessen. Third, we have Ben Horowitz. These guys are legends in the game. Josh Brown, his nickname is Downtown Josh Brown. He's been in New York all his life. CNBC has his own podcast called The Compound. He does a bunch of stuff on YouTube. He's a wealth of information. He does look at a lot of data, whether it's based on market analysis, whether it's based on macro conditions, or it's the charts. He does a really good job with the information he puts out there. He can suggest stocks. He can recommend switch in entire sectors. So he's pretty diversified. Now, Mark Andreessen and Ben Horowitz, these guys are legends when it comes to startups and capital investments. When a new company is born, these guys go heavy. They have incubators, and they're really well known in Silicon Valley. They're also authors and writers. They're very, very informative people, and they've been doing it for a long time. Ben Horowitz's most famous book is The Hard Thing About Hard Things, Building a Business When There Are No Easy Answers. This book is recommended to anybody that's starting a startup and building something from the ground up. It teaches you the routes to take, how to be safe, how to be smart, building cultures, raising money, all types of information for startups and beginners who've never started a business. So this book is really great to give to any entrepreneur that you know. This week, we all experienced something that we haven't experienced from President Trump in a while, which was a really good executive order that helps a lot of people. It's called Accelerating Medical Treatments for Serious Mental Illnesses. It focuses on psychedelics for people that are prescribed to them, especially with PTSD, suicidal thoughts, any mental issues that can be relieved. This is a massive pivot for the federal government, going away from the war on drugs to the right to try model. What this does is it fast tracks any approval that the FDA will be giving to any drug that is seeing success in testing and goes through phase 1, phase 2, or phase 3 approvals. The biggest change comes with the Commissioner's National Priority Vouchers, which is the CNPV. These are vouchers that are allocated to different businesses and states based on their successes. This will shorten the FDA's review process from 1 to 2 to 3 years to just 1 to 2 months when there is success found in any drug. So when a psychedelic drug passes phase 1 review, it'll give access to anybody that has severe conditions. So the people that are struggling the most will have access first and immediately. So the federal government will approve $50 million through ARPAH to match any level investments on the state level. So while the executive order doesn't automatically legalize these drugs, it includes a trigger clause. It directs the Attorney General to initiate a rescheduling review the moment any of these substances successfully completes phase 3 trial, which means basically they're ready to enter the market, and there's immense success found in the results based on testing. I am an early investor in Definium Therapeutics, which is DFTX. You can look it up on the stock market. It used to be called MindMed before it transitioned into a much more technical name, which helps it basically get through the FDA process better. I ended up analyzing businesses that are related to pharmaceuticals that are in psychedelics because when I was writing my book, Muslim in Middle America, Ready for a Debate, I was doing a lot of research in the military industrial complex, and I ended up going towards learning more about the military and the issues they have. And one of the biggest issues they have is PTSD and suicide rates. So once I did more research on suicide, I also found out the second leading cause for death is suicide from ages 15 to 34 in the US. So that allowed me to just basically do a deep dive into the reasons and the solutions. And there was no other solution that I believed based on my analysis that showed that was better than psychedelics. The leading drug that Definium has put out for generalized anxiety disorder is DT120-ODT. This is a proprietary LSD-based tablet. Already has designation for the executive order to give it VIP access to be approved. Definium also has 3 massive phase 3 readouts coming up, which is called Emerge, Voyage, and Panorama. Basically, these 3 drugs have been showing great results, so once again, they can be fast-tracked as they get to phase 2 and phase 3. Definium is using Spravato rollout as their blueprint for pricing and insurance coverage, which gives institutional investor a lot to be confident about. Panorama trial recently updated its enrollment target to over 200 participants after a blinded sample size re-estimation. In plain English, this means that researchers saw enough noise in the data to increase the sample size to ensure the results are statistically undeniable. It's a move for accuracy, not a sign of failure. Basically, everything Definium is doing is showing great results, and people aren't showing a lot of side effects. There are certain things that have happened with heart issues that have come up, but they've been working extensively on resolving those side effects and basically focusing more on the results of easing the pain on PTSD, stress, and anxiety disorders that are very common in the US. Since the executive order was signed, Definium saw a jump of 16% from 22 to 26. Luckily for me, since I'm an early investor, I'm close to up 600% on this stock, and it's been a great investment, both financially and also, just because it's helping a great cause out. And I've seen people struggling with such issues in the US with my friends, whether it's just general stress of life, general stress of where life is headed, traumas, accidents, any type of damage that has affected their minds. I mean, people need relief some way, and if it can be as natural as possible, then why not? even though these drugs are being produced in labs, their roots come from a lot of natural substances that exist in nature. With the combination of expected war negotiations and great earning reports, it's been a great week for the stock market. So for the week of April 27th, May 1st, 2026, S&P 500 is up 0.91%, Nasdaq is up 1.10%, Dow Jones is up 0.50%, gold is up 1.50%, and Brent oil is down negative 4.50%, which has been great for the market and has great upside, because if these negotiations actually execute what they're supposed to be doing, then there's nothing but upside for the market. With the earnings reports, Mag 7 showed great upside and great results. So that's why majority of the market is showing, that they're relieved, because majority of the market is controlled by the Mag 7 because there's such concentration. Now, the tech sector was primarily engine for S&P 500 and Nasdaq hitting record highs this week from Apple, Microsoft, Google, Alphabet, Amazon. Now, the ones that struggle were OpenAI and Facebook. Facebook, because they came out saying that they're going to be expanding their CapEx expenses, even without showing any great results with what they've already done, and not being a leader in AI as what OpenAI and Gemini and Claude is showing. Other than that, as far as OpenAI, since a lot of their business has been spread out to Claude and Gemini recently, they showed a little bit less growth. But at the end of the day, they're still expanding really well. And they've already got so many customers on board that this is bound to happen. So it's not the entire AI market or the bubble that's dissipating. It's OpenAI just seeing more competition, which we knew was going to happen. And other than that, the Claude model is doing much better. Gemini model is doing much better. OpenAI even scrapped their video model pretty early. So with those changes, investors are going to react. Now, my two swing trades that I've mentioned in my other videos, which is CrowdStrike and NextGen Energy, they're both still pretty stagnant. Where CrowdStrike, it goes up, then it comes back down. People are scared based on Anthropic's cybersecurity model that they released, that these software companies like CrowdStrike are going to be struggling. But analysis showing that's not true. We still need CrowdStrike because it's so embedded in the enterprise world. It's so embedded in the governments that it can't just disappear that fast. And I'm still holding strong because I knew I was going to be in it for 6 to 9 months at the max. Where NextGen Energy, it's gone through a lot of approvals to become one of the biggest uranium mining facilities in North America. So the upside is there for that long term. I'm in NextGen Energy for 5 years. It's a really big swing trade, and it could be a long-term hold depending on how results show. For someone like me who doesn't really like to get out of trades that I really find successful, because to me value is more important, even though I'm looking at growth stocks. It's like a balance juggling effect that I do. So as I see fit, I take some profits when I need to. But for me, being in it long term and seeing growth is the most substantial way for me to grow my wealth. Energy giants and shipping companies were affected a little bit based on Iran establishing a $2 million toll through the Strait of Hormuz, and then the U.S. coming out and saying, and anybody that pays this toll will have to go through some type of fine and fees or sanctions. So it's just basically a tit for tat going around right now, which is affecting these businesses and their decision making. For the overall market breadth is one of the biggest issues right now because we're seeing too much concentration. It's basically a few carrying the many. In the markets, this refers to concentration risk. In the economy, it refers to uneven participation. Basically, it's like a mirage. The index looks healthy because it's market cap weighted. The giants mask the fact that the average Main Street stock might be flat or declining. Only a handful of mega cap tech stocks like the Magnificent Seven are actually rising. The market has low breadth. The risk if one or two leaders stumble, for example, if the mythos effect that we just saw with Anthropic affecting cybersecurity companies, if it establishes itself, then we'll suddenly see a pivot from growth drivers to a disruption risk for tech. The entire index collapses because there is no supporting cast to catch the fall. So we need the market to basically diversify itself and kind of spread out to other small businesses, mid-level businesses in the Russell 2000 to basically give some type of support to the rest of the market. This market breadth problem, it can spread into the economy through three main channels. The wealth effect concentration, when gains are concentrated in tech, only a small percentage of investors and employees, mostly in tech hubs, feel the wealth effect. They spread more, but the regional restaurant owner or the small town retailer doesn't see a corresponding boost in foot traffic. Second, capital allocation. Markets act as a giant signaling machine. When all the capital flows into AI and mega caps, it becomes significantly harder and more expensive for non-glamour businesses like manufacturing, logistics, or hospitality to get loans or attract investors. Third, the good news is bad news paradox. If the economy stays strong enough to keep inflation sticky, as noted in the latest Fed meeting, the Fed keeps rates high. This doesn't hurt a cash-rich tech giant, but it puts a stranglehold on the broader economy that relies on credit for expansion. So any combination of these three can affect the economy greatly and cause delays in growth and any type of relief that the smaller businesses and mid-sized level businesses need. The Fed and the economy has seen a great shift, with the Senate Banking Committee approving Kevin Warsh as the new Fed chair. Specifically regarding the Fed's $6.6 trillion bond portfolio reduction. The U.S. economy also undershot growth at 2% rate in the first quarter. Furthermore, the U.S. national debt now exceeds 100% of GDP for the first time since 1946. So a combination of both these things are terrible for the future and the youth and people coming out of college. When we look at real consumption of goods, residential investment, structural investment, equipment spending, it was all negative. Transportation equipment was down in real terms, so it really does feel like the economy is kind of running on one engine. If you look at compensation growth in nominal terms, it's slowing. Wealth doesn't matter to most people because they can't even survive on a day-to-day basis. Wages and salaries are moderating while prices are rising and the Fed is on hold. This is not a good combination for anything. And then little do we know what's going to happen with the war. We're still stuck in limbo. Nobody knows what's happening with these negotiations in Pakistan. The U.S. is saying something else. Iran is saying something else. The page just doesn't seem to be turning. The biggest news that came out the Middle East was UAE leaving OPEC and OPEC+. Now, this came as a surprise, even though we should have kind of expected it because UAE has been immensely investing in their facilities to up their barrel production. I mean, we thought this was for a long-term plan, but who knows, they might have already planned to get out of OPEC and OPEC+ because they were limited on their production, and with the shifts that we're seeing in the world and within their own economy of diversifying away from oil, it should have been kind of expected, but that's always in hindsight, that's how we feel, right? So essentially, the UAE is the third largest producer within the group, accounting for 12 to 14% of total output. The decision is the culmination of long-standing friction and shift in the UAE's national security and economic priorities. The UAE has invested roughly $145 billion to expand its production capacity to 5 billion barrels per day by 2027, when it has been forced to be at 3.6 million per day, limiting its ability to monetize these massive investments that they've already made. With a massive sovereign wealth fund, the UAE's economy is more now tied to global economic growth than to maintaining a specific high oil price. By leaving, it can capture market share autonomously rather than acting as a price stabilizer for its rivals. The exit signals a definitive move towards Washington-aligned strategic posture. This exit creates a breadth problem within the energy sector itself. We are moving from a unified market where most producers followed a single script to a fragmented one. Low-cost, high-tech producers like UAE may thrive and independent actors, while high-cost OPEC members, Nigeria, Venezuela, face increased risk without the collective protection of Saudi-led production cuts. So this is going to be a whole new chapter in how oil is produced and sold in the market.